Alright, so in this lesson we are going to discuss geopolitical events and their effect on currency markets. So while a currency trader can follow news events by using an economic calendar when an event time is known, geopolitical events can come very suddenly and materially impact currency prices. So geopolitical events may include presidential elections, domestic and political news, war, terrorist attacks, as well as natural disasters. So elections can have a material impact on a nation's currency. Elections oftentimes have a large impact on a country's currency because in some instances, elections bring about social and political instability, causing a country's currency to become highly volatile. In addition, a change in government can lead to changes in monetary and fiscal policy, which are both factors that can significantly affect the value of a nation's currency. So here is a chart of the euro-dollar, and this is right around the time of when Greece, when there were fears around Greece leaving the Eurozone. And so essentially, this is an example of an election period. There ultimately was speculation that if one candidate won over the other, there was speculation that Greece could potentially leave the Eurozone, and that ultimately would have had a negative impact on the value of the euro. So as you can see, kind of throughout the election process, as markets became more, nervous about a certain candidate being elected, that is what caused the euro-dollar pair to sell off, because ultimately if Greece were to leave the Eurozone, that would be a significant negative impact on the euro. So therefore that is why the sell-off, this pretty notable sell-off occurred. So also, the US presidential elections can have an impact on the markets. When the US has a change in leadership, there is typically a change in ideology as well. This could entail a change in monetary policy, fiscal policy, of which both impact the level prices of the dollar. Global political news also significantly impacts the currency markets. For instance, the Iranian nuclear deal in 2015 ultimately decreased the risk of war for the US, and in addition, the international trade sanctions on Iran were uplifted. Iran happens to be one of the world's top oil exporters, and the removal of the sanctions allowed Iran to export oil to the international market. This led to an increase in supply in the oil markets, which paired without a change in demand, led to a decline in oil prices. Historically, the US dollar has been negatively correlated with oil prices and would appreciate when oil prices fell, although more recently with the American shale revolution, the US dollar has become more correlated to oil prices. So it goes without saying, war is another very material global event that significantly impacts the Forex markets, and that definitely goes without saying. Natural disasters, whether expected or unexpected, can impact a nation's currency. Depending on the magnitude, an earthquake or a tsunami can damage a nation's infrastructure, which will require funds to conduct repairs. Economic development and commercial activity may also be impaired on a go-forward basis. For example, a hurricane may move up the Gulf of Mexico, causing damage to numerous oil platforms. If the impact is significant enough, this could lead to a decrease in oil supply, which would be beneficial for the currencies of other nations, which are oil exporting nations, because the competitive landscape will ease as less oil would be exported from Mexico. A currency that would stand to benefit is the Canadian dollar, which is highly correlated by oil prices and would stand to benefit if there was a decrease elsewhere in oil supply.